September 15th, 2008. The phone lines at the Federal Reserve went silent. Not because the calls stopped, but because no one knew what to say anymore. The global financial system was hours away from total collapse. Let's go back. The year 2000. The dot-com bubble just burst, but America bounced back fast. The Federal Reserve slashed interest rates to nearly zero. Borrowing money became cheaper than it had been in generations. And cheap money does something powerful. It makes people dream bigger. By 2003, home prices were climbing. Families who'd never owned property suddenly could. Investors saw houses not as homes, but as machines that printed money. Buy today, sell tomorrow. For more. Repeat. Banks saw opportunity everywhere. They had cash to lend. Millions of Americans wanted mortgages. It was a perfect match. Or so it seemed. But here's where things get interesting. Banks discovered they didn't have to hold on to these loans anymore. They could package them up and sell them to investors. Think of it like a conveyor belt. The bank makes the loan, puts it on the belt, and it moves far away to pension funds, insurance companies, even foreign governments. This was called securitization. And it changed everything. Because now, the bank didn't care if you could actually pay back the loan. They'd already sold it to someone else. Enter the subprime mortgage. That's a loan given to someone with bad credit, unstable income, or no down payment. Risky borrowers. In the old days, banks avoided these people, too dangerous. But now, the conveyor belt was hungry. So banks started saying yes to everyone. No income verification? No problem. Can't afford the monthly payment? Here's an adjustable rate that starts low and explodes later. We'll deal with that. Never. These subprime loans got bundled with regular loans into something called mortgage-backed securities, or MBS. Think of it like a fruit salad. Some good apples, some rotten ones. Mix them together, and it's hard to tell which is which. But Wall Street didn't stop there. They created something even more complex. Collateralized debt obligations. CDOs. These were like Russian nesting dolls. You take a bunch of MBS, slice them into pieces, and reassemble them into new products. Then, you slice those again. And here's the kicker. Rating agencies, the referees of finance, gave many of these products AAA ratings, the same rating as US government bonds, the safest investment on earth. Why? Because the math said so. And because the banks paid the agencies to rate them. So why did smart people buy this stuff? 3 reasons. First, housing prices never fall. At least they hadn't nationally since the Great Depression. So even if a borrower defaulted, you could sell the house for more. Easy. Second, risk dispersion. If you bundle 10,000 mortgages together, a few defaults won't matter. It's like a diversified stock portfolio. One bad apple won't spoil the bunch. Third, the model said it was safe. Brilliant mathematicians built computer simulations that proved these products were nearly risk-free. Oh, and banks used leverage. Massive leverage. For every dollar they actually had, they borrowed 30 more. When things go up, you get rich fast. But when things go down, no one wanted to think about that part. 2006, housing prices stop climbing. Then they dip. Then they fall. At first, no one panics. It's just a correction, they said. Healthy, even. But subprime borrowers started defaulting. Those adjustable rates reset higher, and families couldn't pay. Foreclosure signs appeared in neighborhoods across America. 1 house, then 10, then 1,000. Remember those mortgage-backed securities? Suddenly, they were filled with worthless loans. The fruit salad was rotting. And the CDOs, those nesting dolls of complexity? No one knew what was inside anymore. Which ones had bad loans? How many? Investors stopped buying them. Their value collapsed. But wait, there's more. Banks had also sold insurance on these products, credit default swaps, or CDS. Think of it like fire insurance, except you could buy insurance on your neighbor's house, and their neighbor's house, and 1,000 houses you'd never seen. When the mortgages failed, these insurance contracts triggered. Companies like AIG owed hundreds of billions of dollars they didn't have. The cracks became chasms. Summer 2008. Banks look at each other with suspicion. Who's holding the bad assets? Who's about to fail? Trust evaporates. Banks stopped lending to each other. Not for months, overnight. The interbank market froze solid. These are the pipes that move money through the economy every single day. Without them, everything stops. Companies couldn't make payroll. Towns couldn't fund schools. The machine was seizing up. Then came September 15th. Lehman Brothers, 158 years old, the fourth largest investment bank in America, filed for bankruptcy. $600 billion in assets gone. The stock market cratered. The Dow dropped 500 points in hours. Credit markets locked up completely. Money market funds supposed to be safe as cash started losing value. The unthinkable was happening. Money itself was disappearing. The numbers were staggering. But numbers don't bleed. 8 million Americans lost their jobs. Families who'd saved for decades watched their retirement accounts cut in half. Nearly 4 million homes went into foreclosure between 2007 and 2010. A teacher in Ohio lost her house after 22 years of payments. A factory worker in Michigan saw his plant close. 800 jobs vanished in a week. A retiree in Florida watched her savings disappear, forcing her back to work at 68. And it wasn't just America. Banks in Iceland collapsed. Greece spiraled into crisis. Ireland, Spain, Portugal. The contagion spread like wildfire. Global trade dropped 15% in 6 months. The entire world economy shrank for the first time since World War II. This wasn't an abstract financial crisis. It was a human catastrophe. Governments had to act fast. The US Treasury created a $700 billion bailout fund, TARP. They bought bad assets and injected cash directly into failing banks. It was controversial, even hated, but the alternative was total collapse. The Federal Reserve slashed interest rates to zero again. Then they did something unprecedented: quantitative easing. They printed money and bought bonds to keep credit flowing. Central banks worldwide followed. Trillions of dollars flooded the system. It worked. Barely. The patient survived, but the scars remained. Then came reform. The Dodd-Frank Act, 2,300 pages of new rules. Banks had to hold more capital. They faced stress tests to prove they could survive another crisis. Some risky trading was banned. It wasn't perfect. Some said it didn't go far enough. Others said it went too far. But it changed the game. So are we safe now? Safer. Yes. Safe? That's harder to say. Shadow banking still exists, lightly regulated lenders operating outside traditional banks. Financial products are still complex. Leverage is still high in some corners. And human nature hasn't changed. Greed, fear, and forgetting these drive every crisis. But we learned 3 critical lessons. 1. Complexity is the enemy of understanding. If you can't explain it simply, you don't understand the risk. 2. Everything is connected. When the pipes freeze, everyone suffers from Wall Street to your street. 3. Prevention is cheaper than cure. A small amount of regulation and vigilance beats a massive bailout every time. The 2008 crash didn't just change finance. It changed how we see the economy itself: fragile, interconnected, human. The day money almost disappeared taught us that crashes don't come from nowhere. They build slowly, in plain sight, until suddenly they're everywhere. If you found this story valuable, subscribe to The Economic Story. Next time, we're exploring the hidden forces behind inflation and why your grocery bill knows more about economics than most experts. See you in the next story.